Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I'm Arjun Patsati. I have with me on this podcast Sambit Roy, a young credit analyst from Capital Gate Investment Advisor, a SEBI registered research analyst firm. In this podcast, we are going to talk about the rising credit risk in the market, and this could have a potential impact on corporate bonds, especially the higher yielding corporate bonds, where yields could go up due to the higher credit risk perceived by the market. There is a lot going on in the market at this point of time. We have seen on the larger on the larger front, we have seen post the US elections where the Trump administration has won the elections. And due to the perceived policies that the markets have factoring in, the Indian rupee has been deteriorating, has depreciated against the US dollar and has touched record lows. This is due to the fact that there could be tariffs, there could be a fresh tariff war, and this could lead to a strengthening of the US dollar and a weakening of the Chinese yuan, which could potentially take down all other emerging economy currencies, including India. There is also a fear that the higher spending by the US government to pump up the economy could result in US inflation trending higher and the Fed being forced to hold back on rates and US Treasury yields rising. In India specifically, we have seen a rising stress on credits. In our last podcast, we had spoken about this after viewing the results incoming results from lenders, including banks and NBFCs, and this seems to be continuing. And the current second half results are also showing a weakening trend. And given that the market expectations have been very high, as given the valuations in the equity markets, there has been a pullout of funds by the foreign institutional investors, which is also impacting the market risk. So, what is going to be the impact of all this on the market, especially on the corporate bond market? We will come to that. Before that, let Sambit will take us through what are the current macroeconomic situation looking like. Sambit, could you just give a few points on the macroeconomic situation in India at this point of time?
Yes, India is currently facing mixed signals in the second quarter of this fiscal year. Incremental credit growth has been on a downward trajectory. Inflation has been elevated at 6.21% above RBI's threshold, and market volatility is high. These are creating a cautious economic environment, and there is a fall in the credit growth, suggesting a weak credit demand. This could impact broader economic growth as capital intensive sectors like infrastructure, housing, and manufacturing, they all rely on consistent credit growth. CPI has, as I mentioned, has surpassed the RBI's threshold. This could primarily be attributed to a high base effect. The year-on-year inflation has not seen any relief despite efforts to curb the pricing pressures. This, if sustained, could dampen economic momentum in the coming quarters. Quarter two earnings revealed a mixed picture in the corporate front. There has been notable softness in the urban demand, affecting sectors like FMCG and chemicals. Many of these industries has reported earnings below expectations, citing reduced consumer spending and higher input costs. On the public sector banks, they have shown resilience despite credit cost rising for microfinance institutions. There has been some stress, as mentioned by the RBI earlier this year. In the crude prices have edged lower amid escalating concerns about the trade policies under Trump administration. This could potentially instigate a tariff-led trade tensions in the US markets. Furthermore, there has been some apprehension regarding the demand growth in China, a major consumer of global commodities. It faces its own economic headwinds in the economy. The combination of these has added to the volatility and affecting oil importing nations like India. The India rupee has been volatile, recently hitting a record low against the dollar after the Trump's election. The RBI's target for 4.8% inflation for 2025, CPI will definitely stay above the target, potentially curbing consumer spending and impacting corporate profits in the consumer focused sectors. All this might limit RBI's scope for a rate cut in December, which could weigh on the FY25 growth projections. A December rate cut might be likely if the November GDP figures come in. Although some analysts suggest a more cautious approach, this could delay any action until early 2025.
Right. Thank you, Sambit. So clearly, RBI is caught between two crosswinds. One is the crosswinds. One is that inflationary pressures are high, and at the same time, you have the economy that is on a weakening trend, and with rising credit stress, rate cuts could ease the burden on the consumer. But having said that, given the financial market, given the weakening of the rupee and the global financial market issues, RBI would be in two minds for rate cuts in December, as early as December, that is next month, or could they carry it forward to the next year? Coming back to the point of rising credit stress, clearly, what is happening in the corporate, in the lending space is that there is definitely seeing a lot of stress in the personal loan lending, especially in the microfinance sector, as well as there has also been RBI has also been pretty much vigilant on the personal loan, unsecured loan lending as well. And they have, while they have directed a few NBFCs in their last month stricture against carrying on further business, they have also sounded out to the lending community as a whole that please go slow and make sure that there is no financial instability. So what typically this does to the large lenders, especially the banks who on-lend to other NBFCs, is that the banks pull away from giving out more lines to NBFCs. And once banks start either to freeze existing lines, stop increasing lines, or to freeze lines completely, then NBFCs have to curb their lending anyways to make sure that because they don't have enough lines from banks to support growth. And to raise capital in this market in a very quick time is not going to be easy given the market conditions. In all this, so lenders, NBFCs will have to make sure that their liquidity profile is very strong. They have to, NBFCs have three sources of liquidity. One is obviously whatever they have lent as loans coming back once the loans are matured. Second is the lines from the banks, and third is from the corporate bond market. And if in all these three sources, the source that is the loans that are maturing, that will, if they slow down their lending, that will add to their liquidity. But having said that, they would not be able to grow their book and grow their lending, grow their assets, and that could impact their profitability because operation costs are still high because of the fixed costs that they have employed. On the other hand, the other liquidity lines from the market and the corporate bond market and banks. Now, um, um, banks are clearly either going slow on giving more lines, or have frozen it completely. So they'll have to depend on corporate bond market. And corporate bond market typically in such a situation demands higher yields for issuers looking to access liquidity through the corporate bond market, which is a normal case. So this would lead to yields across the high yields curve, which is any corporate bond issuance from AA to triple B yields should be rising, very largely due to the fact that the lenders would have to replenish liquidity, and if they and have in order to service their existing loans and also to repay maturing bonds, and to have a continuum of business, even if it's slow, but they have to continue that business growth. So all this put together, they would have to increase the yields of where they are offering corporate bonds. Even if it, for example, in the last month, the bond, an A-rated bond was trading at say 10.5%, it typically should rise anywhere from over 10.5% levels. It could be anything depending on the corporate performance, etc. And yields should definitely rise, whether it's 11%, 11.5%, 12%. That's really up to the market to determine given the risk appetite. So investors, especially the investing community here, should be aware of these risks and should be aware that yields should be rising and demand higher yields for investing in bonds, especially if they are comfortable with all the fundamentals. So clearly, or they should weigh the risk, given that risk factors are increasing, they should weigh the risks of investing against the returns they're getting, and then they should invest accordingly. So that is the message that this podcast is sending out. Clearly, um, uh, the market is seeing higher risk across, even in the other markets, including equities and the currency markets. Risk is increasing everywhere. So corporate bonds too will see higher risk being priced into yields. So hence investors should be watchful of what are the yields at which they are investing, and they should compare what were the yields say 2 months back to where it is now. If they're the same, then they should either ask for higher rates or avoid them altogether. Thank you for listening in, and do be aware that corporate bonds do carry default risk, interest and also interest rate risk where prices can go up and down, and liquidity risk where the impact cost of selling bond can be high. Once again, thank you for listening in. Do follow us on all podcast channels. Thank you, Sambit.